Shana, just based on the rate outlook, what's your expectation in terms of how credit growth will pick up in the current financial year? Because most of you, when we engage with you, you keep saying that the large part of credit offtake is by way of working capital. Are you seeing interest or, inquiries in terms of term capital, term loans being extended?
The term loans that are really getting disbursed currently are, out of the loans that we had sanctioned in the last 2 years. Because term loans are really sanctioned for projects, and projects take 3 to 3.5 years for implementation. So while we are not really doing many new approvals on term loans, but there is a disbursement still taking place, because the past projects, which have started, have not stopped. So the implementation of those projects is still going on. So the credit growth really this year will come from, one is the past disbursements out of the past sanctions. Then of course the increase in working capital, then increasing housing loans, and some amount of increase even in products like car loans and commercial vehicle loans.
Sure, but just staying on the corporate front, would it be right to say then that fresh sanctions for term loans are not happening in the current environment?
The fresh sanctions for term loans are much lower than what they were, say, 2 years ago. But, the stock of sanctioned but undisbursed loans for projects that are moving quite okay, I mean, that stock is currently pretty large with the bank. So for the next 18 months or so, I think there's enough disbursement to do out of that stock itself.
All right, and on that note, if we could just focus on the retail space, you did talk about housing loans being, growth continuing to be robust, auto loans continuing to be robust. Would you say that what the corporate sector is in some part not being able to do for you in terms of credit growth, the retail sector is making up for that?
No, I think actually both are growing probably at the same pace. I mean, even the retail growth is not the 35% kind of growth that one had seen, in the early 2000s. So I think both the retail and the corporate are actually growing at similar rates.
Sure. And in terms of the net interest margin picture, do you expect that ICICI Bank can maintain its NIMs at current levels for this financial year, or do you believe you're going to see some pressure somewhere?
No, in fact, I have said that, our NIMs for the current financial year will be higher than what they were for the previous financial year, because the previous financial year we had a NIM of 2.73%, but that was for the year as a whole. By Q4 we had actually reached a NIM of about 3%. So I think the year is actually going to see an improvement over the previous year.
So what kind of improvement are you expecting, and where would you ideally like to see NIMs go and settle at?
Well, I think as of now, getting 3% or close to 3% is what we are aiming at, which is anyway an increase from 2.73 of what it was last year, and then we'll take it year by year.
All right. Now, to the extent that credit deposit growth is continuing to lag credit growth, and it's been happening for a while, would you say that the banking system is in some way headed for a structural challenge in some months' time?
No, actually the deposit base for the banking system is larger than the credit base. So, the kind of difference that we have of about 2-3% between the credit growth and the deposit growth, that's fine, because a 2% lower growth rate on deposit of a much larger base can fund the credit growth, even if that's 2% higher. So I don't think that's really a challenge. But of course, that's a well-known fact that the Indian banking system really has access to more shorter-term funds compared to the assets. But that's the other issue, not really to do with the quantum of deposits available to fund the asset growth.
So now, in terms of asset quality, given the outlook people have sort of forecast in terms of GDP growth, to the extent that those growth rates have been lowered, do you worry about asset quality taking a hit on account of that?
Actually, I'm not overly worried about the asset quality taking a hit, because when the growth rate changes, one is of course the total growth rate of the banking sector may change. But when it comes to quality of assets, let's look at it like this. The retail assets are actually still very stable. They're performing very stable, because in India we lend to the customers against their income, and people still have their jobs, people are still seeing increments in their salaries, and therefore the entire housing loans, car loans, etc. are performing on a stable basis. On the corporate side, the issues that are arising today with some corporates are really more specific to those corporates, either because those specific corporates would have over leveraged, or because some of the projects would have gone delayed. So they're very company specific or project specific issues, not as if it's an underlying phenomena across the entire corporate sector that they are suffering. So I think if the bank has selected the projects appropriately and the exposures appropriately, I don't see too much of surprises on account of NPAs. And in fact, there were a few companies and projects that needed restructuring, and I think the bulk of the restructuring has been done last year. Not to say that nothing more is going to get done this year, but I think this year's numbers are going to be less than the last year numbers.
Right, so there have been these forecasted numbers being put out by research agencies saying that the banking sector will need to restructure, or sort of will see NPAs of something like 200,000 crores additionally in the current financial year. Would you say those numbers are a little exaggerated?
I would think so. I mean, there are these because we have to remember that again these assets do not become NPAs. I mean, the normal tendency of the outside world is to equate restructuring with NPAs, and therefore whatever amount you think is restructured, you start counting it as NPAs. But if you remember, in the Indian economy, which is a growth economy, while certain projects may get delayed, while some of the cash flows will get delayed, but because there's always an underlying demand for the products that are produced from that project, over the 10-year period or 12-year period, the loans get serviced. So, the experience for the banking sector has been that just about 15% of the restructured assets have really become NPA in the past. For ICICI Bank, well, it's actually been around 5%. So it's wrong to add up the entire number of restructuring and say that that is an NPA number.
Now, within these stress sectors like, steel and textiles and maybe infrastructure to some extent, aviation even, of the loans restructured, how have you seen the asset behavior after the restructuring? Would you say there's cause for worry even now?
No, I would only say that it's too early to really judge, because what happens in restructuring is that you generally postpone the collection of installments. So, I wouldn't say that there is cause for worry now, but I also wouldn't say that there is reasons to start celebrating, because really the obligations of repayment will happen over the next few years. So we should just watch.
All right, now just focusing on the banking sector at large. On the one hand, there is this whole buzz about new bank licenses going to be put out very soon. On the other, there's this whole talk about the need for consolidation within the Indian banking system. How would you view both of these events playing out?
Well, I think, an economy that's a growing economy, we can always debate whether it's 6, 7, 8 or 9, in a growing economy, the banking sector will grow at about 2.5 times the GDP growth rate. So I think the banking sector will grow anywhere between 15% to 24%, depending on whatever we believe the economic growth rate for India is going to be. So in a growing economy, both needs exist. I mean, there is always room for many players, but at the same time, there is really a requirement for banks to become bigger, because we are not just a growth economy, we are also an investment economy, and the part of our growth is really going to come out of large investments that we need to make, and those investments have to be funded by banks. And for that, we need to have many more banks which are bigger in size, which really have the capacity to fund the growth of the Indian economy. So I think consolidation or banks becoming bigger is definitely required, and it's going to be the natural phenomena of India's growth. New players coming in, I guess there's enough role for everyone to play, but banking is not that easy a business that that starts becoming very viable at very small economies of scale. So I guess business models will have to be found that become viable at different levels.
Sure, but on that same note, would you agree that the banking sector in India hasn't grown as fast as the corporate sector has? Because already there were reports just some time back about one of the largest banks in the country not having busted its exposure limits to one very large corporate. So would you say that to that extent, the banking sector hasn't grown at the same pace as the corporate sector, and somewhere borrowers are being forced to look outside as well?
No, I think first of all, the Indian banking sector has actually not just funded India's growth, but catalyzed India's growth. Because even if you look at an example like ours, when the Indian economy was really a manufacturing-led economy, we also in the first 40 years of our existence actually funded projects. In the 2000s, when Indian economy was a consumption economy mainly, we really focused on funding retail. Now, had we not made retail funding available, I don't think consumption would have grown. And now you are seeing both consumption and investments moving, so, we're growing both our businesses. So I think the ability of the banks to fund whether the consumption side of the story or the investment side of the story has been very strong, and the banks have played a very important role in funding the growth. But we are at a situation as a country where our investment needs are much larger than what just the domestic funding can support. And any additional capital flows which take place from abroad only become additional sources of funding to actually advance our investments. So I won't say that, the corporates have been forced to look outside, but I would say that given the stage where the economy is, the investment requirements are just that large that Indian banks need to continue to grow and fund that. The other forms of funding need to continue to play their part to also fund the investments.
Right. Now, I know we keep asking you this question every time we meet. The ICICI Bank's plans in terms of listing subsidiaries, is that on track, or given the current environment, has it been put on the back burner?
No, I think our intent to monetize, some amount of investment from our subsidiaries is very much on track. But when we take the step, would really depend on, what is the right situation in the market, when we think we are getting the right valuations. So I think those are, when you take the step, you really decide in terms of the best timing. Currently, first of all, these companies are all making good profits. They are generating good return on equity for us, on the equity that we have invested. They are not really consuming any new capital from us, and the bank, the parent itself, has enough capital. So, we are not really in a hurry to raise more capital. So we are not going to do it for the sake of the requirement of raising capital. We are going to do it whenever we can optimize the value. So we'll wait for the right time.
All right, Chandra. Thanks very much for your time.
Thank you.